everyone, and welcome to Tuesday Meet Session. Tuesday Meet Sessions are audio sessions only, and today's topic is Gallup criteria to select ETFs. So, without wasting much time, let us invite Dr. Ram to take forward this session. Over to you, sir.
Okay. Thank you very much for joining this meet. We'll start the discussion right now without wasting too much time. Today's topic is about ETF and how to select ETF. ETF means exchange traded funds. Okay, so we'll restrict about the restriction criteria. We won't go into investment strategy discussion. Before we begin the discussion, let me clarify a few things. Today's meeting is only for the education purpose. It is not investment advice. I am not a SEBI registered agent or advisor, although I have a qualification of AMFI registered MFD, that means mutual fund distributor, but I don't sell any mutual fund. I only educate. Okay. And today's topic is about ETF. If I ask you the question, what is ETF? Can you write in one sentence or few words in a comment? If you're watching on YouTube, write in the comment what is ETF, or you, are you investing in ETF? You can write yes, no as well. That becomes easy question. Okay. So the ETF full form is exchange traded funds, and name itself suggests that it is listed on the exchange. That's why exchange traded funds. So ideally, it should have been called as exchange traded mutual fund, because it is a type of mutual fund. And those are passively managed. Passively managed funds, that means there is no requirement of fund manager, only the computer algorithm and administrative team is enough. So the cost of ETF is also very less. First, I'll discuss the criteria, then we'll discuss briefly about where to see and demonstration. So it start with the category. Mutual funds is a PIV, that means pooled investment vehicle. It means thousands of investors come together, they pool their money, do and then fund manager or the asset management company invest in the underlying assets. Those can be equity, debt, or gold. So instead of retail investor buying directly to the in the equity, gold, or debt product like bonds, pooled investment vehicle is uh, designed. It is basically a trust. There is an entire ecosystem of how this ETF works. But today we'll restrict discussion to the uh, only selection criteria. So category. What are the categories? Categories we will mention into under three categories: equity, debt, and hybrid. These are the mutual fund categories. Usually ETF of hybrid category is not available in ETF. So we'll remove this. So there is another one, gold. So these are the categories of ETF. There is silver as well. Okay, gold. So these are the metals, precious metals. But we will say these are the categories. Equity ETF invest into the shares of domestic company. There are some ETF which are international as well. That means they invest into the companies listed in the USA or some other market, but they invest into the shares only. Shares have a different nature of price movement. It is a volatile. We call this as a fast and fluctuating price movement. Debt means bonds, deposits, certificate, short duration, long duration, government bonds. And the prices of bonds usually does not fluctuate, although there is a fluctuation based on the demand supply. But over long term period, or maybe 3 4 months, usually you won't lose money in the debt fund. Exceptions are there because of some default and etc. But usually there is no volatility in the debt. Gold and silvers are based on the market price of gold and silvers in the physical market, so their price also fluctuate. So when you design a portfolio, you create a portfolio in which multiple assets are invested, and we call it as a diversification. Suppose you create a portfolio of uh, 10 lakhs. Uh, Based on your goal target, you will have to do the asset allocation, maybe 50% in equity, 30% in the debt, 20% in gold. Now, this 50, 30, 20, these are not standard. I'm just giving for illustration purpose. You just divide it. So let's go to the next point in the uh, criteria, that is asset under management, AUM. Uh, Higher the asset under management, better, because then you will have the liquidity. So next point is liquidity. And if under management is high, then expense ratio might be less. The next comes the expense ratio. I'll show where to see the liquidity and what is the expense ratio. And fourth, next criteria is tracking difference and tracking error. Okay, so this completes a CALET criteria. This is for to select the ETF. To exit the ETF, you can see the return with the index, underlying index. And if the expense ratio is increased, usually if asset under management is high, liquidity will increase. It won't reduce unless mutual ETF is uh, under pressure. So these are the five things, CALET criteria, one by one. Category under the equity, you find whichever has the highest AUM, then which has a liquidity, which has a low expense ratio and low tracking error. High. Now, how much high, there is no standard, but when you compare with the peer group, you understand which has high and which is low. So let me show a website which our team has developed. You can take a snapshot or write down the website name as well. This website is we launched recently. Uh, it is a beta version, so you'll have to check with other website like Amphi. But after few weeks or few months, this is going to be very easy for you to do analysis of mutual fund and ETF. So if you click on the home and you go down, here is the mutual funds and here are the ETF. The difference between ETF and mutual fund is ETF are listed on the stock exchange and you can trade like share or you can buy anytime during the market hours. You can sell yourself as well. So price of ETF fluctuate every day. Mutual fund price is decided at the end of the market. It is called as NAV and it is declared in the late night, maybe 10 or 11 o'clock. So mutual fund will have only one price, that is net asset value. ETF price fluctuate during market hours. Let's click on the ETF. So we have developed a website this and those criteria are added. You can say we have demonstrated here. Age, it may not be much relevant, but AUM. Okay, so AUM is, should be highest in a particular category. Let's go to first category then, because there are hundreds of funds. Let's go category of ETF. Okay, and let's select. See now here, AUM is 3,400, 3,436 crores. Here it is higher. Expense ratio. When you search higher the lower the expense ratio, better. Okay, so let us say you want to see the Nifty Bs, then there are tracking error, tracking differences. They'll also come. So you see that this first name represent the asset and AMC, that is asset management company. Second word represent index and ETF. Okay. So now let us see this mutual fund, Nippon Bees. This is the most popular index, uh, Nifty 50, that is Nifty 50 index, and Nippon is the oldest ETF investing in the, and the name is Nifty Bees. B stand for, previous old name was benchmark uh, exchange fund. Okay, exchange scheme, benchmark exchange scheme, but now it is just for historical significance. You see their expense ratio is 0.03. Lower the better. Any ratio, if it is less than 0.1, it is good. 0.34 is little higher. Okay, so I'll go to the next website. Can you highlight my okay, Amphi website? Type tracking difference MP. Let me share the screen. Now the previous website, our website, it is under development, but I'll just introduce you. This is the website where you will see the other data, that is official Amphi data. You can type on Google tracking difference Amphi and you will then get the data. So here is the tracking error and tracking difference. Let's select this July. Okay. Okay. So what is the tracking error and tracking difference? Tracking difference is uh, how much return is given by the uh, ETF versus index. Okay. And it should be zero. Tracking difference should be zero. Tracking error should be zero. So if it is minus here, -2, what it means, it is giving, let's say 1 year or 2 year data. Where is the data? I'll show some scheme. Okay. Understand the concept, then compare. So this is 1 year. In last 1 year, this fund has given 0.07% less return than the index. In 3 year, this is now increased. Okay, 0.17. So it is most of the time it is minus. So tracking difference is the difference between portfolio return, that is ETF return, minus index. And the error is the standard deviation of uh, daily difference. This is cumulative. So tracking difference is cumulative number. How much difference in last 1 year, 3 year, 4 year. So tracking difference is a cumulative difference. Tracking error is the standard deviation of daily difference. So what software will do, they will calculate everyday return of the ETF and the index, and then it will take the standard deviation of, let's say, 1 year, every day it calculated, and then it will calculate the standard deviation of entire 1 year, and that will be analyzed standard deviation. So tracking error is the standard. Write down, you can if you want to write. Tracking error is the standard deviation of the difference between ETF and index. Difference of return. Okay, difference of return. And tracking difference is cumulative return, which is more important for investing purpose. Tracking difference is little more important because it is obvious. This is just a standard error, or we say it's a it will measure the volatility. So basically, this will represent return. The way we have alpha. So if you understand, the alpha is the portfolio return minus index return. Okay. So this is like the alpha. We will not use the word alpha because concept is slightly different, but this will act as a alpha. How much alpha? And this is most of the time negative alpha. That's why we will not use alpha. It is a negative alpha because it is most of the time negative. And this is the standard deviation. So this represent return, this represent risk. Higher the uh, standard error, uh, higher the risk. Here, we don't want low return. It can be zero. Usually positive alpha is rarely. If it is positive, that means again there is some index is not doing proper tracking. So tracking difference should be zero. Ideally, tracking error should be also zero. Both should be 0, 0. Ideally. But in ideal scenario, does not exist. So you can check tracking errors as well. Let's say you want to select one mutual fund of, okay, So here you can see Nifty Bs or all from the Nippon. How much is the tracking error? I'll show the Nifty Bs tracking error. This is Nifty 50. This is a Nifty B is what we are looking for. You can find our tracking error as well. Here direct regular mention, but it is all are direct only. There is no agent involved. Okay. So here you find the tracking error, tracking difference. Now let's go to the NSE India website. Click on the exchange traded funds. Where to click? Go to the home page. This is NSE India website. Market data, exchange traded funds. So you get all the exchange traded funds here. And then click on the value here. Rob. Okay. You can download this data as well for analysis. Okay, let's open this and do the analysis on this as well. You can see there are almost 300 ETF. Ideally, mutual fund or investment industry should make life easy, but they keep making life complicated. So here we are finding out which is the mutual fund which has the highest value. Okay, we can sort data. You can delete the not relevant points here if you are screening. So NAV as such is not relevant as of now. For to find the liquidity, we can use 2-3 parameter, out of which value and volume can be used immediately for the comparison. Okay, I will delete all these things. Okay, and then we can sort by index as well. Let's say you want to find only index uh, under no underlying asset, right. Nifty 50. Where is Nifty 50? Let it will be first sort by A to Z. Okay, then we have to sort by underlying asset. Okay, underlying asset means underlying index. I'm showing because for one index there can be multiple ETF. So let's see the Nifty 50. In gold, you can see there how many ETFs are there. Almost 8, 10 gold ETF. Suppose you want to buy a gold ETF. Okay, so what will you do? You will find whichever has the highest volume and value. Now I'll delete this. So can you write down which has the highest volume? This is the value. D was value and this is volume. Obviously, you can see uh, in the gold. Okay, these are the gold ETF, out of which this is the highest. This is second highest. So you can select any three at the beginning based on the liquidity. And let's say this three you found that I want to do the further analysis. And then you can find the expense ratio of this. Okay, expense ratio as well as tracking error, tracking difference. Let me show Nifty 50. Okay, so this is a Nifty 50. There are again 15, 20 funds. Okay, so all these are ETF. So what are the category? What is the category? So index represent the category first. C. So we say we went to the category, that is equity and index. Then AUM. We can find AUM on the ETF mutual fund website or AMP both. Then CALET. So okay, category, AUM, liquidity. So you can find the liquidity. Which are the top three in this three? These are the top three based on the liquidity. Top three, four. Let's separate them. So first is category. So we selected Nifty 50 is the category or underlying index. Then AUM. Usually if there is a high value transaction, obviously its AUM should be high. So this value gives us a proxy that AUM must be high. You can check as well, but if like volume is high, automatically AUM will be high. Okay, so this gives the liquidity, and then what remains is the expense ratio and tracking error, tracking difference. Okay, I shown where to look for the tracking error, tracking difference. Okay, so let's go again, find out, check आ गया कि नहीं tracking error. Okay, Nippon को करते हैं, Nippon. So this is a Nippon. So here this information is incorrect because formula is not correct. But let's go here. And you can find the tracking error, tracking difference of all these three you've shortlisted. How to check? You just go to this MP website. You can check the different tracking difference as well. Let's select NIF1 and July month. And you compare three funds and find out which has the less tracking error. Less means toward zero, not minus side. It means you may say that -5 use less than the -1. No, not this way. Towards zero. Okay, towards zero. If it is more minus, then it is not good. Should be less minus towards zero. So this is the criteria to select ETF. Now, since there are 400 ETF, you really don't need all of them, because what you need is in a equity, you need one large cap, and it is very easy. Nifty 50 you find large cap. Another you can go to next 50, that is next 50. So this is another index which invest into the large cap. So here you can take whichever has the highest volume value. So let's say this one or two. Okay. One Nifty 50, that means one index based on the Nifty 50. Another is next 50. This I'm talking about equity. Both are large cap. Then you want to have mid cap as well. Let's search at mid cap. So this is a mid cap now. Now, in this, there are so many mid cap 100, mid cap 150. So, proper mid cap index is this 150. So, you can select this and find out. You don't have to invest in all, only one is enough. Whichever has the highest turnover or volume, automatically their expense ratio will be less. Their AUM will be more. So this is one screening is you can do. Uh, Small cap is also there, but small cap liquidity may not be there available. So in case of if you select the Zerodha has uh, gold ETF, but this is recently. One more index. Okay, so even silver is there. So this is silver. Those who are keen to invest into silver, you can find it out. So from data from the NSC, if you are not comfortable with the Excel, you can still sort from here as well. It's not complicated, and find out which has the highest value. Okay, if you at the top, you see that silver bees is the top. That means 880 crores turnover. That means bought and sold on that particular day today. Next is gold bees, then liquid bees. Okay, third category I was talking about uh, debt fund, debt category. So liquid bees is the debt fund, but don't invest into liquid bees because their taxation is complicated. So alternative is liquid case. This they invest into the debt product, short term expiry product. So silver, gold, equity, debt. That means all the desired categories you have volume. You can see that. Uh, And as you go down, you may have multiple mutual fund of same same category or same index. Okay. So if you want to do little more search on this based on the liquidity, so what you can do, those who have traded less than the 1 crore, you can delete straight away for from your list. So your life become easy. So from here, these are all traded less than 1 crore in per one day. That means out of 400, you removed almost 70% in just single click based on the liquidity and value. And then you can sort and find out two, three among each uh, category. So what are the categories here? Major is equity, debt, and gold, silver. Okay. Under the equity, now you have to understand the indices. What are the index? One format is based on the market capitalization. Market capitalization is the market value of company. That is number of shares multiplied by price. Under the market capitalization, you have large cap in which Nifty 50 and Next 50, then mid cap, and then small cap. Next is based on the sector. There are sectoral ETF as well, for example, bank, auto, pharma. There are many. Okay. Then there are thematic like energy, defense, AI, and based on, and then strategies. Now, these are for the people who have little more knowledge and more experience, thematic and strategy. When you check, there are so many names, you will get confused. What is this momentum? Uh, what is this volatility and all this thing? But these are for alpha 50 and so on. But for the beginner, you can focus on this in the under the equity segment. At the most, if you have the knowledge of industries, then go for sector. Otherwise, uh, this is more than enough. Large cap, mid cap, small cap. Thematic strategy is only for the people who are experienced. Now there are international funds as well. Let's go into again, download the and check the underlying to find out international indices. Whether you should invest or not, that is a personal choice. Uh, let's check here underlying asset, where if you see the USA index, you can stop here. Domestic. See, mod 100 is one of the market. See, this is uh, Hang Seng Tech. So this is international fund. Invest in China and Korea and the things. USA market behave. So life has made so much complicated by these people. Where is this is also MCXI. This is also international index. Nasdaq 100. This is also international ETF. ETF is Indian, but this fund invest into the in the international market. Okay, the risk is here is that they are traded at little premium. Otherwise, this is the easiest way to invest into the international market. You don't need any other formality, compliance, no RBI information, nothing except the high valuation. There is no other problem in investing in this international funds. Okay, right. So this is the CALET criteria. As such, is it very easy? Even beginners can do it. What is the main challenge is category selection of the category. Once you decided category, then finding this is very easy, because in that category hardly there are 5-10 funds which you can select based on the uh, high value and high volume. Both go hand in hand. Focus on the high value instead of volume, because sometimes volume can be confusing, because their NAVs are very different from each other. So take only one criteria from here. You download this data. I am showing again here. And then sort and select only the value, delete everything else, so that it will be easy for you to find out which mutual fund has more turnover, largest to smallest, and remove the funds which have less than 1 crore uh, turnover. Because if let's say this is hardly 3 or 4 lakhs turnover, how are you going to place the order when you want to exit? Okay, because low liquidity has one more problem which I will show here. Suppose this is the okay. So since market is now closed, you will not see the order book here. When market is open, you see the uh, there will be prices, bids and sell prices. So ask price. This is a seller price. Seller price. Okay, and this is a buyer price. If there is a lot of difference between sell minus buy, it means there is a huge liquidity problem. Okay, how much difference we can tolerate? We say that sell price minus buy price divided by sell price multiply by 100. If this is more than 0.2%, then it is not liquid. So ideally, it should be less than 0.1%. You may ask, what is the difference between what to do between 0.0 and 2? It is a, we say, experience based, but the ideal is this. So if it is more than 0.2, straight away discard. This is the, we say, ask bid difference. Now market is closed, so we cannot see the numbers here. But when you check in the during the market, take the highest, topmost price or ask price, that is sell price, minus by bid price, and do this calculation. There is one more parameter which tells us the liquidity, and that is called as impact cost. Impact cost. Where is that? Yeah. So this is assignment for you. Check the impact cost. Okay. You compare impact cost of different funds. Lower the better. This represent liquidity. Higher the impact cost, lower the liquidity. Now see the impact cost is 6.78. I will show the Nifty B's impact cost as well. But before that, one more point you will have to understand is the I now. That is indicated NAV. When you place the order during the market, or preferably your price should not be too high than the I now, because it is the real price, and market price uh, may depend upon demand supply, but this is indicated by the AMC. So when you place the order, try to place below this. Sometime it may not be you may not be able to execute order, but then you have to do the trade off. Now you can see this is the 78.2, 78.72 is the I now, and now this is higher than the I now. Try to buy low below the I now, or at least at the I now, not above to above. Okay, so let's show the Nifty B's here for comparison. Okay. So check impact cost. See, the impact cost is less than 0.02. Okay, so this lower is the better. Okay, if you want to remember, uh, you can say that it should be less than 0.1. Okay, you have seen in a previous it was 6, too much high. So impact cost should be less. Check the I now 279. 279. It is close. That means you can buy at this price. It is close to the I now. I'll show one more interesting for Nifty. No, not Nifty. Come on. इसको बोलते हैं. ठीक है. This is the current price 331. And if you check I now, you can see the indicative. Can you tell me what I said about I now? Write in the chat box. This is indicative NAV provided by the NAV. And the current market price is 333. It means how much extra? 25 plus this. 53 rupees extra. That means this is the real value, or current value based on the asset price, and this is uh, market price. People are ready to buy at higher price. This is called as premium. So that is the reason this is one challenge in the ETF, because there is a lot of demand nowadays. There is a lot of demand for the international investing since last 2 3 years. I don't know what has happened, whether it is a new trend or fashion, but it has a lot of demand, and this is the one reason that it becomes difficult to invest into this, because this gap, that means the real value of uh, fund is 272 based on the asset, underlying asset. Meta, Google, all these companies must be invested in that, and you are paying this. So you check I now, you check impact cost, okay, and you can check uh, the value. So straightway rejection criteria: if traded value is less than 1, out. If impact cost more than 0.1, out. If difference between asset and bid price is uh, I said zero point 0.1, more than zero point 0.1, out. So you can uh, reject all this based on this parameter. So let's summarize what we discussed now. We discussed कैलेट तो है ही, इसके आई नाउ. We discuss impact cost. We discuss value. We discuss ask, bid, spread. It is called as a spread. It should not be too high, or we'll say uh, close to high now. If you are getting lesser price, that is well and good, but it may not be possible. Impact cost should be less than 0.1. Value should be more than 1 CR, and this also should be 0.1. This is for selection or rejection as well. You can, if any mutual fund ETF is impact cost is more than 0.1, you can reject. If it is less than 1 CR, reject. Here 0.1, reject. So this can be hacked as a rejection criteria as well. Okay. So apart from this, uh, liquidity expense ratio, tracking error, tracking difference, it should be low, means close to zero. So you can summarize this all the points in the selecting ETF, okay, and write in the our basic finance group. You can post some questions in the comment. I'll try to answer those. Admin, you can post those questions in the Zoom meeting. Okay. Question is हिंदी में बोलो, समझ नहीं आ रहा है. Oh. How can we start SIP in ETF? Yes, you can start SIP in ETF via broker. Zerodha has the facility to start ETF, ETF SIP. And one interesting factor here, that in SIP, in a ETF, you cannot have the fractional unit. In case of mutual fund, you can have fractional, but here fractional unit is not possible. So your SIP may be slightly variable in each month. Uh, Instead of all this circle, is it better to stick to the index funds? Okay, let's go. Uh, Which index funds? These are the index funds only. Okay, index funds and ETF. Okay, let me clarify the difference. Passive funds are index funds and ETF. Suppose Nifty 50 is an index. There will be almost 20 index funds and 20 ETF. Now my question to you, if you want to invest into index fund, which index fund? For the Nifty 50, there will be at least 20 index fund, 20 ETF. Okay, so circus is required. Okay. ETF SIP, I said ETF SIP you can do on Zerodha. Impact cost. Okay, so impact cost you will have to read little more, but in a brief I can explain. Suppose when you see that current market price is 70 to 79, okay, and there are orders listed here. Okay, when you check on the here, and if you place the larger order, especially previously it was defined that if you place the market order of 2 lakhs, how much price, how much extra price you have to pay than the topmost ask price. That is called as impact cost. Okay, impact cost is how much extra payment you have to pay to the market order of 2 lakhs rupees. If you place the market order, how much extra than the uh, top order of top ask order, that is impact cost. So lower the better. Now since the market is not live, otherwise I would have explained and shown exactly what is impact cost. Maybe previously I used to show direct order putting the live order, but now this is market closing. So today we'll focus on the criteria, because strategies, everything will be a lot of things to discuss in 1 hour. The exit plan, or we call this as IMP exit plan. Whichever the asset, be aware. Okay, this is for exit plan or all asset, whether it is ETF, whether it is mutual fund, whether it is share, whether it is gold, real estate, any investment will be exit plan based on these 3 factors. One is investor. Second is market prediction. And third is portfolio. Okay. Suppose your goal of, see, when you invest, you are planning to save some or other day. So goals are usually based on the price or time. Time-based goal means you want to sell after 5 years, 7 years, 8 years. If it is time-based goal, you just sell at that year whatever the price you are getting. That is time-based goal. And this is different for each investor. So there is no standardization. Second is a price-based goal. This is also based on the investor. If your price is that my price should double or 50% or 300% return, if that return is achieved, whether in 6 months, 1 year, 2 year, you exit. That is price-based exit. Second is market prediction. Those who learn technical analysis, fundamental analysis, they can predict what can happen next 1 year, 2 year. Then they can reduce their equity position, invest more in the debt. That is called as uh, tactical asset allocation or based on the market prediction. Third is based on the portfolio. Suppose you decided that you want to have the portfolio, equity portfolio and debt portfolio, and equity you want to have 70%, equity 30% debt. If market increased rapidly, so your ratio get deranged, that now it has become 80-20. So in that case, you can sell some equity and buy the debt to do the rebalancing to the original ratio. Okay, that is based on a portfolio based, or it is also called as strategic asset allocation. So IMP, that is what we discuss in the invest trading mentorship program. Okay, this is exit, and this exit is for all assets. Okay, fourth type exit, you may say that I don't want to sell it, or I want to uh, give to the my daughter, but that is again your personal. Okay, so this is exit for each investor, each investor, each investment, whether it is ETF, mutual fund, gold. You should invest only if you have the exit in mind. What should about your fund? What is the question? But acha, debt fund. Okay, so debt fund ETF, there are very limited option, uh, and the purpose is to park funds for shorter period. Okay, so debt fund, liquid funds, liquid case, and I shown 2-3 example. You can check on this underlying asset, and you will see that debt category. Let's say this one, liquid ETF. Okay, so this one, but don't invest into this liquid ETF and liquid base, because taxation is complicated. Liquid case is little ideal or easy for you. Okay, please don't consider these are all investment. This is just illustration. Okay, we don't give any investment advice. This is purely education platform. How to sell liquid fund? So sell of liquid fund and buy, you have to do the via the demat account, right? So another question, ETF or mutual fund, which is better for pledging or for option trader? Option trader should know this, because today's session is only for the ETF. So we'll drop this question. Thank you very much. We'll stop here. We'll wind up. Okay, thank you.
Thank you, sir, for the wonderful session. And thank you, all the participants, for joining in.